Hi everyone, my name is Steven Jackson with Integrated Wealth Management. A few weeks ago, I came to you discussing the first bucket of our three-bucket approach whenever it comes to retirement income planning. Today we're going to focus on this middle bucket here. Now, while the first bucket's most important attribute is making sure that we have complete liquidity, the attribute of the income bucket is making sure that we are not experiencing a lot of market volatility. Now, whenever we have that sorted and taken care of, now we are able to take more risk on that growth bucket, and we're going to talk about that in a few weeks here. But to help you wrap your mind around that income bucket, what kind of assets go in there? Like I said, we want to make sure that the principal is completely protected, yet we are still experiencing some growth within this. And so all of these investments have something in common. And so that's going to be something like a CD, perhaps a bond ladder, if structured properly. Certain types of annuities are fantastic here because we're able to take part in a lot of market upside without losing any of the principal whenever the market goes down. There's a lot of structured products like structured notes and structured ETFs that give you an extremely significant yield with just a little bit of market risk. And things like dividends, as long as we are certain that these dividends are going to continue regardless of the fluctuation of that underlying asset. Okay, now we're going to talk about, for the rest of this video, one of the biggest risks whenever it comes to retirement income and the withdrawals that you make within retirement, and that is known as the sequence of returns. What the sequence of returns principle states is that it's not just going out and trying to get the best average rate of return. What actually matters as well is when those returns actually are happening and when those are occurring. Okay, and so if you think about it, whenever you're working, you're contributing to your 401k, it doesn't matter quite as much. You love to see the market go up, you love to see that 401k increase, but if it does go down, you're still contributing every 2 weeks, every time you get a paycheck. And in fact, it gives you that opportunity to invest whenever the market is down and gives you more momentum whenever it comes back up. Now, whenever you're retired or looking towards retirement, the opposite occurs. All right, so let me give you a quick scenario that proves that it doesn't just matter what the average rate of return is, but it also matters when those returns are happening. So we're going to take $1 million and we're going to look at two different clients retiring at different points in history, and all I'm doing is shuffling around the years of those rates of return. We have year 1, 2, 3, 4. All right, first year, client loses 20%. He needs $50,000 to live off of, so he's still taking that $50,000. Year 2, ouch, another down year. By year 3, we're seeing the market turn around a little bit. Okay, we have 10% up, and then fourth year, fantastic return, 30%, wonderful. All right, however, we're still taking $50,000 out a year because guess what? Bills are still due, grandchildren are still being born, a lot of things are happening. So here, year 3, the client is entering year 3 with $600,000, a 40% decrease from just 2 years earlier. That's pretty painful. Now let's just flip these numbers around. Client retires, 30% increase, 10% increase. Then we have the bad times rolling. Down 10%, down 20%. Okay, same exact average rate of return, we're just inversing those. He's taking $50,000 out a year. By year 3, this client has $1.2 million in his retirement accounts. Okay, now as bad times come, we're able to see that this client finishes out the 4-year period $100,000 more than that previous client just because of when those returns were occurring. Okay, let me give you another example. Let me pull you into it and show you what happens if you were following a lot of these retirement principles. All right, congratulations, you just retired. You have $1 million in your 401k, and you do a lot of research, you do a lot of reading. You know, the podcasts, they tell you if you can stay within that 4% rule, which means you're only pulling out 4% of your assets every year, your assets are going to last forever. So year 1, you pull out 40K. You have other income, Social Security, pension, you're making your spouse work still. Well, wouldn't you know it, first year market is down 15%. That means you're exiting first year of retirement with $816,000. No big deal. We can come back from that. 816,000. Now we have two choices. We're going to pull $40,000 out again, or because you're disciplined, we're going to stay with that 4% rule. 4% of 816, about 32,000. Well, guess what? Market is down 15% again. Right now, this kind of feels unfathomable just because of this wonderful market increase that we've had over the past years. But this has happened in history where we have 2 consecutive years of losses. Just think back to the financial crisis. Look back to 3 consecutive losses in the early 2000s with the dot-com bubble. And now we are leaving the second year of retirement with $660,000. And now you have the choice again. Man, inflation's been crazy. Do I pull out $40,000 or do I stick to that 4% rule with that $660,000, which comes out to be like $26,000 a year? If you stick with $40,000, that's a 6% withdrawal rate from this number here, which means now the market has to average 6% a year to sustain any kind of retirement withdrawals that you have. This is where the income bucket comes into play. What we need to avoid is pulling your income out of assets that are volatile. We want to make sure that this year's paycheck is not relying on what's happening in the market right now with the kind of volatility that we could be expecting. You break this down on a monthly basis, we could end with a positive year, yet still have less in your account just based off of the volatility that we have seen from month to month, because most people take that income on a monthly basis. We're not saying we need to avoid market volatility as a whole. We just want to make sure that the volatility is in their correct places and those conservative pieces are structured in such a way that you're able to do everything that you want in retirement. So what now? So let's say you are on the cusp of retirement. You're really excited for it, but you're really nervous of everything that's happening in the world right now. We have a new Fed chair. We're uncertain what's going to happen with interest rates, oil, war in Iran, a lot of uncertainty out there. May be a good time to contact us and start talking about that income bucket and what is the best way to set up this 3-bucket approach. Let's say you've been retired for several years and you've been enjoying life and you've been doing everything you want to do, checking things off that bucket list. Well, what's happened in your IRAs and your Roths and your non-qualified accounts is we've just had incredible growth. Maybe it's time to take some chips off the table and move them into something a little bit more conservative so that whenever we do have a rainy day, you know that you have a big chunk of your assets that are going to be protected, that are still making some money, and when you need income, you don't have to reach into your stocks that are depressed. All right, so you know where to find us, Integrated Wealth Management. Give us a call, 330-896-1644. Thanks.